How you doing? Yeah. Well, one of the things they're not educated. They don't know. Whatever.
Love it. Okay, we are gonna talk so fast today because I want to leave as much time as possible for our guest speaker, Matt Green. But I would love to hear at least two people tell me something good in your world that is going on in the last 24 hours. Ooh, what about that?
One, I got to see a bunch of my family that I never get to see over the weekend.
Woo-hoo.
And then, stick on all of our Beyonce plans.
Yeah, I'm gonna give a double. Let's give a, I feel like we can get way better. All right, we need one more. Yeah,
We have put 14 offers in for our client and he finally went under contract.
Great job. Awesome,
And we
awesome.
got 2 new listings.
And 2 new listings. I super love it. I'm sorry, we're not gonna share any listings today. We can share them after, stay and mingle when we have lunch and share your new listings with everybody. But I want to make sure we have enough time to go over what we're here for today. No.
I helped.
Oh. Okay, scam alert. You guys. Okay.
You don't need a gift card, seriously.
It
I
will
got it.
say, so you're gonna get this, and now they've used me, I actually got one myself this time, which was pretty exciting. When they said, hey Rusty, hello, it's Rusty Edwards, so that was pretty good, and I got my own text. But you're gonna see this now swapped out, you'll probably see Matt in here, you'll see Marcus, you'll see Sean, you'll see Ken, you'll see Eden, you'll see all the people. None of us ever, in the history of ever, are we gonna call you and say, please go and get me gift cards and send me a snapshot of them. I may call you and say, are you coming into the office? Will you stop by Starbucks? That's realistic. This is never gonna happen, okay? So as much as I would love you to all just send me hundreds and hundreds of dollars, please don't. This is a scam, okay? And I think, is that everything? Those were our announcements? Oh, there we go.
One more.
Okay, so August 29th, we are doing Allison. Tell us about this.
The Summer Sizzle 1000. So,
Summer Sizzle.
yeah, so a bunch of MAPS coaches put this together for brokerages. So as Keller Williams as a whole, we're trying to make 100,000 contacts on that day in particular. So, our office is gonna contribute at least 1,000 of those contacts. We're gonna have fun, we're gonna have food, it's gonna be a party. We're gonna do script practice. We'll provide numbers. We have for sale by owner, expireds, and just listed, just sold, circle dialing numbers, and you can bring your own SOI to call. We're gonna be calling all different kinds of people, so come. It's gonna be from 9 to 4:30 that day.
The whole day event. We're gonna take a little break for team meeting in the middle. And share some mega camp stuff, I think. Or we can keep calling. I'm fine with whatever we want to do. But we'll have lunch, we'll have some snacks throughout.
So
So
party, it'll be a good time.
if you guys.
It'll really set your fourth quarter up.
Yes. Fourth quarter is always when people start to panic and go, we don't have anything in our pipeline. This will fill your pipeline. So you're gonna cruise through the end of the year. Christmas is coming, folks.
Christmas is coming.
Christmas is coming. It's right around the corner. And you guys have a lot of gift cards you gotta buy for me. So, we have to work. Okay. And if you have any other questions, let us know. Congratulations. Tom, you graduated something nice. We didn't have his picture. If you just want to stand up and I'll bring your award and shirt over, or do you want me to come up here? Whatever you think. Should we take a little picture? Oh, wait a minute. Hey, you gotta walk fast. Okay, it's Cammy Crow here. Cammy Crow.
Wes is here.
Wes. Yeah. I really am taking your picture. Please, just for you.
What do you want the other video up there? Like,
All-
take a picture at the end.
Okay, all at the end, yeah.
Okay.
Chris Baylor, stay here.
John left.
He knew.
Oh,
He knew.
Chris
He
is
knew.
my friend. Stand right over here, please. I'll be there. Okay. Perfect. And I'll have your shirt too. Are you getting it, Ashley? Yeah. Perfect.
Yeah.
Okay, you guys look at Ashley. Look at Ashley.
Love it.
Yeah. Nice. You can move on, Rusty. Okay, I think Bailey's gonna talk to us at the end, is that right? Okay, awesome. So we're gonna jump right into the quarterly market update. So some of you may be confused because we've been advertising it with Marcus Green, but we have actually the one and only Matt Green here today. Okay, if you guys don't know Matt is phenomenal. He's been essentially every position within Keller Williams other than Gary himself. And I
Like
think
Gary,
that
though.
probably.
No,
maybe even
so,
more.
yeah, so Gary doesn't allow, so I've been, it's great to see many of you, first of all, it's been a number of years, including you, and, it's helpful. So for those of you that don't know me, I'm Matt Green. I've been the last 3 years living in Austin, Texas, where I've been part of the executive team for Keller Williams International. So a really great honor to get invited by Gary to come work with him. And he has a rule that no one's allowed to have a mustache on the executive team. He's the only one that's allowed to have a mustache.
Is that true?
No. But immediately after, so I've just moved back to Utah. I did my 3 years, and my kids hated living in Texas. And so we were anxious to get moved back to Utah. We're from Utah, we're Utah. And so we just moved back. I moved back in May. And I've been here for a couple months. And we're really thrilled to be back. But as a joke, I thought it would be funny to grow a mustache. So when I see Gary at Mega Camp, I could go mustache, mustache. Anyways. So it was funny, I was up here visiting with Steph for just a minute ago. Many of you know my brother. I'm gonna let you down immediately. You're excited to see Marcus. I'm not nearly as egregious or fun as Marcus is, but well, thank you. Anyone else?
To Marcus, and he told me I should tell you.
You know.
Yeah.
this thing.
Well, yeah, so that's Steph was sharing with me that, so Marcus and I are partners in a number of our businesses together, and was it 9 years ago or something? 6 years ago, 6 years ago, Marcus was trying to make an impression apparently, and did a cartwheel at the front of the room. And he'll do anything for a laugh. And so he did a cartwheel in front of the room, and he completely split his pants, like right. So I will not be doing it now. So thank you all for being here. This is one of the things that Marcus and I are passionate about, is doing these economic updates for a number of reasons. In fact, as an agent in Park City for years, one of the things that really helped me set myself apart from other agents in that market. So for those that don't know, I really started, 20 plus years ago as a real estate agent up in Park City. I still have a team that sells up there today. But as a means to kind of set myself apart, I really focused on generating these market reports and communicating about the market in a way that most other agents weren't. And so Marcus and I have always been really passionate about helping the agents in our industry understand what's going on in the economy and be able to facilitate conversations with their clients in a way that helps those clients make good decisions. So right now, if you think about the conversations that you're having with clients, are people fearful or slow to act more so than they were a year ago? So I say yes. Yeah, and I think as you look at the numbers, you're definitely going to see that. And so in part, one of the things that we want to accomplish today is to help you get some of those talking points, those dialogues and data points, so you can have meaningful conversations with your clients in a way that helps them make good decisions. Now, you've heard us kind of as a company transition from using the word scripts to conversations. And in a lot of ways, I think that's healthy, but there's a certain negative connotation around the word scripts. Why is that the case? Why do you think there's a negative connotation around the word scripts? It's just a genuine, what's that?
Doesn't sound like.
Doesn't feel like me, right? Okay. Feels very salesy. Yeah, so in many cases, the idea around scripts was this idea that we were manipulating people to do things that they didn't want to do. Now, if someone does something that they don't want to do in the near term, over the long term, are they going to be happy with you? No, right? At some point, they're going to look up and go, "That son of a gun talked me into doing something I really didn't want to do." However, the reality is if you really examine your speech patterns, you have adopted a certain speech pattern, regardless of whether you want to call it a script or not. You tend to say things the same way over and over again. If you hear me speak enough, you'll hear me say certain phrases or certain things over and over again, just because that's habit. We're habits, but as humans, we naturally adopt these habits, right? Those are scripts that you have internalized and you say the same things over and over again. When we talk about scripts and or conversations, what I'd like for you to think about is helping you be more efficient in your speech. When we're more efficient in our speech, we then can help people navigate the conversations that they're having internally in their head to make decisions that get aligned with their goals. So if we can be effective in our speech, we can help people come to a conclusion on what they want, aligned with their goals more quickly. And if we can do that more quickly, right, we're doing a great service to them because it's helping them get off the fence and make a decision one way or the other. And it also allows us to have more conversations with more people. So as we think about some of the scripts or conversations that we're going to shape today, it's really about helping people make better decisions more effectively, more efficiently, more quickly, so that they can make the decisions they want that serves their goals better. And those goals may not always align with our goals in the short term, at least, right? Many of you probably heard the word commission breath. Anyone heard this concept? What's commission breath?
What it told that.
What's that?
What the money.
Yeah, the consumer is assuming that we're going to tell them whatever they need to hear in order for us to make a commission. And so I think data plays a really important role in helping us have a third-party source that validates what we're saying. So the consumer naturally, who's going to be skeptical of what you're saying, can look at some portion element of a third party, data in this case, that supports what you're communicating to them, to give them a better confidence of what you're kind of consulting them on. All right, so I want you to think about this from the standpoint. What do I do if the clicker doesn't work? Oh, just slow.
You pray a little bit.
You pray a little.
Right. Okay.
Right now. Yes, there we go. I don't know why that.
Okay. Good, good. Okay, so as we think about today, one of the goals of today is to help us shape our conversations in a way that supports our clients to make decisions aligned with their goals. What do you think a second goal of today would be for us? Why is it simple?
25 bucks.
Second part of it is, I think there's a lot, I think not only from a consumer standpoint is to know how to help the consumer, but I think, you know, with agents that I know, even I are meeting with agents every day, and I think there's a lot of uncertainty, even in the agent's mind, around what the market looks like, and knowledge is power, right? It's going to help you better navigate your own business if you understand the economics of it.
Yeah, perfect. So really, as I thought about the two goals of today, one is to help our agents get better at having these conversations, giving them the tools and data pieces to have those conversations that support the client's goals. Number two is to really understand the market at a point from the standpoint of how does this affect my business, and what do I need to do in order to ensure that I have the success and the income that I want aligned with my goals. So, you know, years ago, when we went through a really significant downturn in 2008, 2009, we call it the Great Recession. Many of you in the room experienced that. If you didn't, you know, lucky you. But it was a really tough time. And in Park City, we saw within a very short period of time, 20% of the transactions that we were experiencing just 2 years previously. So 80% of the transactions just disappeared. And of course, as agents, we make our money on transactions, right? And so I had to figure out a way to not make 80% less money in my life. And that's what was generally happening to most agents. So when we think about the market and understand the market better, we can start to pivot and approach the market differently in order to make sure that we're getting our unfair share. All right. So this really goes in alignment with this quote, and Marcus has been sharing this a lot with a lot of our different partnerships. This is from a great book called Compound Effect by Darren Hardy. And I'll just read it to you. I'm going to battle this thing a lot. It's not until situations are difficult, when problems come up and temptation is great, that you get to prove your worthiness for progress. As Jim Rohn would say, don't wish it were easier, wish you were better. Okay, I like that. Think about how do we get better? It's not gonna get easier. In fact, I kept thinking it was gonna get easier as my kids got older. It turns out being a parent of adult kids is harder than young kids. They started to like have their own ideas. Okay. Can everyone see this okay? This is probably a kind of a hard one to read. This is the Utah strength of the Utah economy relative to the United States. And you can see the red line kind of stands out as Utah. So you can see over the last decade, we've performed really well relative to the paired in other states in the country. What's interesting when you look at the pandemic in the United States dropped, Utah didn't drop quite as much, but we recovered much more quickly than the rest. I guess does this have a pointer? No pointer. Okay, I'll use the finger pointer. But you can see we recovered much more quickly than the rest of the country. And then if you look at where we're at today, Utah's at 2.6%, while the US is at 3% growth. So we're lagging a little bit behind the US nationally right now, but in aggregate over the last handful of years, we're still well above the average. Okay, so land of opportunity, and when this is really looking at GDP and growth and job recovery specifically, you can see Idaho is #1, Utah's #2 at 6.6% in the country. So really strong. St. George again was recognized as one of the fastest growing metros in the US. So Utah continues to see a lot of growth. Jason Abrams, for those of you that know, Jason is from Michigan. And I always make fun of him because I'm like, nobody wants to live in Michigan or the Midwest. And everybody, sorry. Everyone's moving.
And it's green and that's nice sometimes like.
And human. What's interesting? Well,
Just go away when I go there.
you'll see that the Midwest actually is outperforming in the last handful of months is outperforming, a lot of the West, especially Utah and some of the other areas that saw really significant run-ups in values. Okay, so this is home sales annually across the country. And this kind of dotted line here in the middle is the average over the last 30 or so years. And you can see the number of sales that occurred after the Great Recession dropped dramatically. We saw that build back up over time, and over the last couple of years, 2020, 2021, were significant, numbers of homes sold relative to the average. 2022, we saw a really significant drop, and we're experiencing that this year as well. All right, so let's look specifically over the last handful of years by month. And this, gives us some indication on where we're headed for 2023. So the red is 2023, the teal is 2022, it's purple in color, and yellow colors are 2021 and 2020 respectively. But you can see month over month, the numbers for 2023 are significantly lower than what they've been over the last couple of years, which is really interesting. Of course, 2020 was right at the beginning of the pandemic. These first couple of months is right when things started to shut down. So you saw pretty strong months, January, February, and then the pandemic hit. So based on this trend, we're likely to see, far fewer homes in 2023 as far as number of homes sold than what we've been experiencing. And that's the case here in Utah as well. So Utah annual home sales, this goes from 2003 to 2022. At any point you have a question or want to make a comment, feel free to just interject, let this live session. So number of homes sold, here the dotted line is the 20-year average. So normally we sell about 43,000 homes. 2022 we sold 42,000, and we're likely going to be below that this year based on the pace we're going. Okay, so Utah homes sold for 2023 by month. Again, similar to what we saw previously, but you can just see, January off significantly, February off significantly, March, etc. Right through June, dramatically off where we were just a year ago, and way off from just a couple of years ago. So, I mentioned, earlier that over a 2-year period during the Great Recession, we saw a number of homes built in Park City drop by 80%. Right now, we're about 45% off of our high 2 years ago on homes sold. So, dramatically fewer homes being sold. Okay, so let's look, and these are some of my very favorite reports that the Wasatch Front MLS puts out. So if you're not getting these on a monthly basis, I really encourage you to download these. As I, met with buyers and sellers, I always had a little packet that I always have printed out with me with these kinds of data and stats, again, to be that third party validator of the things I'm talking about, to give them perspective. And I think there's a lot of value in doing that clients appreciate. All right, so let's look at these kind of key metrics. New listings, you can see June of 2022 at 682 versus in 2023, 406. So new listings down 40.5% from the same period last year. Closed sales down 15.9%. So 291 home sales in June of this year versus 346 of last year. That probably doesn't surprise anybody, right? I mean, you're living this and experiencing this. So it's interesting though, what are we seeing with prices? Because in most cases, when you start to see, dramatically fewer sales, which would suggest in most cases less demand. You'd also see like what we saw in, 2009, 2010, prices are coming down.
Coming down, but not dropping. That's what I said, about 10% off of where you're at. Some are getting more, still getting multiple offers, some are just the property we put.
Yeah, is that what most of you are experiencing, Billy? Yeah, it's remarkable how robust pricing has stayed. And so we just haven't seen much deterioration in pricing and values yet. And really the challenge is what's supporting that?
Well, it's not as many homes on the market.
That lack of supply, right? There's still just this dramatic lack of supply. And I would encourage you, that's one of the things that you're really going to want to keep an eye on. Now, you're going to see a lot of data today that would suggest that there's probably not a path where we see a lot of supply coming on. What's the one factor that probably could impact that the most? What would unpick? Yeah, rates would have to drop dramatically. Yeah,
Everybody's at 3%.
that's right. So the one thing that really could change, inventory. This was interesting. About this time we were in the cycle in the Great Recession. I was building spec homes down in Phoenix, and I was watching that market down there. And the inventory went from 5,000 active listings to 20,000 active listings in about a 6 to 9 month period. So just huge number of listings came on the market. We don't see anything that would encourage or would likely support that happening here, with the exception potentially of rates getting back down to like 3.5%, which is very unlikely.
I think if they even got to 5, I think a lot of people would.
It would shake a lot of inventory free. Yeah, I agree. All right, so that was Davis County. Let's look at Weaver County. So I want you to look at just a little nuance here in the two. So in Davis County, if you look at average sales price, average sales price is down year to date 4.8%. Whereas in Weaver County, it's down 6%. So more deterioration in pricing in Weaver County than Davis County. What do you think? Why is that the case?
The reason I think is because in Ogden, I remember the time when you could buy 100 houses for $100,000 in Ogden, easy, any day of the week. And then all of a sudden you couldn't buy anything under 300,000. So I think they overappreciated Ogden.
And I think when you're looking at the lower price point too, I think they're going down quicker because depending on the price point, right? It's qualification with the rate, right? It all still kind of comes down to how much does it cost you to borrow the money? And if there's more inventory at a lower price point, that price point is also the most pressured in a rate meeting, right?
Yeah.
For the most part,
Mhm.
because it's typically a little bit of a different income status and economic status.
Yeah, anyone else?
We haven't thought about too much for this moment, but you know, you got that. So as your residents, you have when you sell, you have a credit with the government, which isn't enough anymore. And so that's also affecting people who sell it.
Say that again, no, I don't
So
understand.
as a resident in my home, I have a $250,000 tax
Oh,
avoidance.
yeah,
That's not enough anymore.
Yeah.
I'm single and I have a $500,000 house now. I'm gonna be paying taxes, so that's another reason for me not to sell.
yeah. Okay, so, yeah, I think all great points, but I think that when we look at Weaver relative to Davis and the price appreciation that occurred, Weaver really appreciated a lot compared to Davis. And it has a little bit more room to come down, and that story can actually be applied nationally. When we look at those markets, like Utah, Idaho, Las Vegas, Austin, Texas, some places in California, that saw this incredible run up. They're actually seeing prices deteriorate more so than the Midwest. The Midwest is actually seeing price appreciation year over year right now. In fact, most of the country, about 45 states in the country, are year over year increase in price values. Whereas there's a handful of states that are actually a little bit down, Utah being one of them, because of the fact that we saw so much appreciation compared to the rest of the country over the last handful of years. So kind of interesting as you look at that, but from that perspective. All right, days on market, as you would expect, we're seeing increases on days on market. 2022, 23 days versus 57, so 147% increase. And still, that's interesting, even though yeah, the incredibly low, when you think about historically, number of days on market, we kind of use this 6-month benchmark.
I was gonna say.
Which is hilarious about some of these conversations that we're having with new agents, because they're like, can you believe it? The market's so terrible. And, when you think about it, yeah, like over a 20-year period, like this is like historic low days on markets. Like the market's still really, really strong from that perspective. So we're still very squarely in a seller's market. Seller has the advantage. All right, so US home prices. You can see this yellow trend line is assuming about a 4% average appreciation rate. We do want homes to appreciate each year. It incentivizes investment and home ownership. But we want to manage that investment. And in fact, we'll talk a lot about this scary word that everyone's talking about, inflation, and why that's kind of a triggering point for a lot of us to raise rates and be concerned about it. But we want this 4% appreciation rate. So this is assuming that 4% appreciation rate. You can see right before the Great Recession, we were well above that line. We trended well below that line for a decade. And only just recently bounced back up above that. So the good news.
That for your sellers
Yes.
and for your buyers, because they, in their brain, are thinking, no, that's not right. There's no way to pay. That's a good thing.
Yeah, Scott, thank you. That's what I was just going to encourage is if you don't have this one printed out and in your, file when you're meeting with buyers and sellers, this one's really helpful for them to understand that we're not nearly as overinflated as a lot of people think we are. And in fact, now that we've come off that 410 number, we're actually getting much closer to that trend line. So we don't anticipate, a huge retraction in prices for a number of reasons.
By the way, we'll share these slides out, so if you didn't sign in, make sure you sign in with me before you leave today, if you want a copy of the slides.
So home prices, median sales price, generally, the interest rate's gonna move inversely to home prices. So as interest rates go down, it encourages prices to go up. As interest rates go up, prices tend to come down. And despite, interest rates being higher than we've experienced in 20 years, we're still seeing in most parts of the country, the home value starting to tick upwards again. However, we did see a period of time where they retracted a little bit. You can see this is the US median home payment in principal relative to the interest rate. So back in 1990, the average home payment was about $605, interest rates of about 10%. And you can see how that's really changed over the last couple of years. And that's all a combination of two things, really, home prices, but even more so, it's the interest rates, right? So the cost of home ownership for someone who's taken out that standard loan, it's gone up dramatically for them. It's interesting, the number that we use frequently as we talk about this around the country is someone that could have bought a $600,000 home, you know, a year ago, today probably is only qualifying for about $450,000 to $425,000 home. And if you think about the difference in quality of those two homes, it's generally pretty significant in most markets. Okay, any questions or comments?
I think because you touched your brain, you gotta just put it back over there. Now you should have control again.
Okay. There we go. All right. So median home price comparison in the thousands. So you can see Utah in the green, United States in the purple, and you can see just how we've outperformed the country over the last several years. But as I mentioned, we're actually seeing just a little bit of a retreat in Utah, whereas the country in whole, in aggregate, is actually still seeing home price appreciation. You touch your thing again. Okay. So year over year annual home price appreciation. Pretty familiar with this. This is 18.2%, is just crazy. And that's, of course, one of the reasons why we're seeing interest rates aggressively tick up based on what the Fed's doing. And then Utah home prices, again, last couple of years, 25%, 13%. And so far, you know, year to date, we're down around 7%. I think actually most updated information is a little closer to 6.5. So US inventory annually, this is really looking at months of supply. So most economists will look at the past 3 months, many will look at the last 6. But essentially what we're looking at is assuming that no new inventory came on the market based on the last 3 months of sales, how quickly would we sell through the inventory of homes? And this is going back there to 1999, and we could even go back another several decades. And we just don't have any period of time that was as low as the last couple of years. And so, again, you know, even at 2.9 months of inventory, it's just incredibly much in a seller's market. The 6 month number here, again, is really giving you an indication of that bifurcation between a buyer's market and a seller's market. 6 months of inventory would suggest a balanced market. So we're squarely, deeply still in a seller's market. Now, do sellers feel like it's a seller's market today?
No.
So do you use that script? You use the word stupid enough. So what's the conversation that you're having with sellers right now when they are feeling this element of pain or frustration? And yet, you know, all of the data would say, you know, stop complaining, you're in one of the best seller markets ever. Like, what's your problem? Yeah, Dave.
I mean, it depends on what I need to do.
Yeah,
I have a seller right now. He's told me at least half a dozen times that he's not gonna hire me, then not listen to me, and then he proceeds to not listen to me. It's really fascinating to see the blindness. But he's gripped with a lot of fear, and he's seeing a lot of negativity about the seller position of the market that he's in, and he's overpriced. I'm telling you that. So I need him to reduce. So I don't bother to correct him with historical averages and all that, because that's not what he needs. What he needs to know is silver priced, and he needs to get more aggressive with his stuff. And he's got to sell because he's already moved out. So it really depends on the situation that the client is in and what their reality is, because their perception is their reality. And I have to either correct or not correct.
Yeah.
Based on what they need.
Yeah, and I want you to focus on the part of the conversation where he said what they need, right? Because a couple times you said what I need, and it sounded like, it could have been misunderstood.
Yeah, sorry.
Right,
What,
yeah.
what I need them to do in order for them to get
Yeah,
it
what they
done
want.
that they hired me
Yeah,
to do.
Yeah, which is exactly right. And tying people to that motivation is really important, and then helping them understand reality. And that's a challenge that we have as real estate agents, is having those dialogues. And in some cases, you just have to let them, miss out on a couple offers or whatever before they learn. But that's our opportunity, is helping them understand trajectory in this case, right? So one of the things I think is really important is to help them understand, even though we're looking at this from the standpoint of it's still one of the best seller markets in history. When we look at the trajectory, one of the key things for us is to make sure our clients are on the right side of the trajectory. If they're behind the trajectory and always chasing the trajectory, they're going to be continually frustrated. So in a market where the prices are dropping, you could find a scenario where your seller is continually reducing the price, but just never quite reducing it enough. And helping people understand the value of getting in front of the trajectory is really, really important. I just was helping my brother and sister-in-law buy and sell a house. And at one moment, they had a really good offer on the house. And they're like, did we underprice the house? And I'm like, there's so much risk in, trying to eke out a couple more $1,000. You're so much better just getting this thing closed, because we could potentially find ourselves on the wrong side of trajectory here. So, all right. So inventory, I'm not clicking in. Thank you. All right, US inventory. So again, by month over the last 4 years here, and what would we expect that's going on with inventory? Year over year, inventory is actually increasing compared to what we see in the market. Now, what's going on in Utah? Sorry, my clicker's not working. So United States inventory is increasing year over year. We're going to look at Utah here in just a minute. So let's look at US new single family home units completed. And this is, this is from 2009 to 2022. This is the average number of units completed over the last, 50 plus years. And you can see over the last decade, we've just been well short of the number of units needed in the United States. So US single family home units completed in thousands, again, just looking at the last 4 years. What we need to have happen is year over year dramatic increases in the number of homes and units being created. What's actually happening though is we're still not recapturing those homes that we need built. So still significant shortages. When we look at Utah specifically, we finally started to make a dent. This is the number of homes that were short in the United States. So they take effectively the number of households, families that are trying to form a household, buy a home. And they look at the amount of homes that we have available, and they calculate, do we have a surplus or do we have a shortage? A surplus is going to lead to what with prices? Prices would come down. A shortage is going to make prices go up. Since 2011, we've had this dramatic shortage of homes. Now, fortunately, in 2019, 2020, there came off a little bit of pressure on the buyer side. We got more aggression from the builders and so forth, building more homes. And we started to make a dent in that.
What are you doing?
Few months, it's starting to turn the wrong direction, and we anticipate based on the
Are you looking for your mom?
Request for new building permits, et cetera, that we're going to see a significant shortage over the next couple of years.
Have you guys seen this in your own worlds? Right, like I've had a builder that canceled his whole subdivision, because they said, oh no, we gotta pour our energy into what we already have existing. Right, so I think especially builders who got caught with a lot of inventory, are really pumping the brakes way more so than they should be, which is really gonna create a problem future forward. Right? Because we already have a lack of inventory. If we stop building, it's going to continue.
Yeah, yeah, go ahead.
And I've also seen builders start building a lot smaller homes to help with that.
Oh, you don't know any builder.
Oh, I don't know of any.
I have a question. Does that new construction take into account, new construction of rentals, of townhomes and apartments?
Yeah, all households.
In Ogden, I don't know who else is doing it around, but there is a zillion apartment complex, townhome complexes and everything going on. Oh, I mean, everywhere you drive, it's like, oh, there was a lot, but you know, down 5-story.
So, yeah, so you see all of this inventory being built, and we might assume or think that it's enough that it's gonna meet the need. But all the projections that they are looking at is saying there's still gonna be far below what we're gonna need. So, but, you know, Rusty said something really relevant, I think, is especially a lot of the national home builders, but certainly a lot of the local bigger home builders, they were so hit and crushed during the last downturn that as soon as they got any inkling of us heading towards a recession or a problem, a lot of them put on the brakes really quickly. And so when we saw what happened during the pandemic, even though everyone was surprised by the amount of demand that still occurred during the pandemic, most of the builders who were all anticipating a significant slowdown, many of them defunded or slowed their building. Now, the other thing that occurred during that period of time, which we'll show in just a minute, is the cost of building has gone up dramatically. And regulatory issues have not made it any easier as well. So here are the places, the dark red shows the places where we're likely going to have the greatest shortage. So this indicates the number of units needed over the next 9 years. And compared to the number of units that we've built the previous 9 years. And the places that we're most concerned about where we're going to see likely significant shortages are in these 3 counties primarily. But you can see all of the major counties are reflecting significant shortages. So housing demand is going to continue to way outpace our housing availability. Okay, so annual months of inventory. You can see Utah specifically at 2.8 months of inventory, up dramatically from 2021, but still historically super low. And then this was the one that I was suggesting earlier that we wanted to compare against the United States. So months of inventory, and you can see, January, February, March, up dramatically from just a year ago. So from that perspective, in many ways, it feels like the market is slowing down. And you can see we've just hit our high at 3.2 months. Okay, new listings. What do we need right now? We need more listings, and we're not getting them for all the reasons we've talked about. And we don't see anything that would suggest a trend in the last handful of months that would suggest that we're trending towards a market where more listings are coming. In fact, 2023 is going to be down dramatically from 2022. So percent of new residential listings sold on the Wasatch Front. This is really interesting to me. This might be a fun graph to have as we approach the holiday season. But look, what do you think this month is that spikes every month or every year? December. So when does everyone thinks it's a terrible time to sell their home? December. But this would suggest differently. Like this would suggest that actually putting your home on the market in December is a really great time because you're not competing with other people, et cetera, et cetera.
Wow.
That's correct.
Decorated.
I really surprised me. I had to double check it.
Yeah.
And yeah, you get the tax advantage of that year, yeah. So this is the same chart. This one's just looking at the last 4 years by month. And you can see, November, December, very high, as you'd expect based on that past trend. But again, we're just not seeing, month over month increases that are very significant. June did outperform 2022, which is a good sign. But from a trend standpoint, we're still off. Utah home
It's not
sales.
the highest June that we've had in 3 years this June,
Oh, wow.
from a listing
That's it.
perspective. So it is, I mean, you're looking at that and you can say whatever, you can look at whatever you want, but that was an interesting, from our leadership perspective, when we're looking through the numbers, we're like, wow, we actually had the highest June we've had since 2019.
So I'd be curious what your guys' thoughts are on this. One of the things that we're starting to see and hear is that over the last 18 months, a lot of people were like, okay, this rate thing's not gonna last very long. Let's just wait and see what happens. And now people are realizing this rate thing's probably gonna be around for a while, and they're like, okay, we just gotta deal with it, and let's figure out how to get a deal done. And so we're starting to see, at least what we're hearing across the country, is transactions are happening despite, people are kind of coming off the sidelines and saying, we're gonna do deals regardless now. A little more. Are you guys seeing that or feeling that a little bit? Yeah. And I think that's a really healthy conversation. In fact, when we look at this here in a minute, it's very, well, look, you said this earlier. It's very unlikely that we're gonna see rates, see any kind of significant retraction in the near future. And certainly, the likelihood of us seeing them back in the threes, may not happen again in our lifetime, quite frankly. All right. So Utah home sales, off dramatically the last couple of years. But if you look at the last couple of months, we're starting to see a little bit of a nice tick upwards. I lost my clicker again. Okay, here we are by month. So you can see June, even though we outperformed significantly, the state was about even from what they were a year ago. Home sales year over year. Let's look at pending sales. So no new story here really, other than we're well off what the historical averages have been. Kind of like this month to month because it gives us a good indication what the trend looks like. Good news is we're getting closer to year over year changes in June. So maybe that's a suggestion that maybe we're hitting the bottom of that trough. That might see things getting better. US days on market, talk a little bit about this, certainly month over month, it's getting more significant, and Utah up to 57 days on market year to date. Similar graph here, you can see in the red, dramatic increases year over year. All right, mortgage rates. So this is back to 1972 to 2022. And what are when we think about, we're going to talk about affordability here for a minute, because that's a really important conversation. When we think about affordability, what are the things that impact affordability in the market?
Bring price to the home rate
Price of the home, rates, and income. Those are your three kind of metrics that you're thinking about. So understanding affordability really is understanding those three pieces of the puzzle. We know what homes have done over the last handful of years. The great news is that we are not seeing the price appreciation that we've experienced, hopefully giving us a chance to kind of get back into an affordable model. Interest rates are up dramatically, which is really impacting affordability. And income, how is income doing in the state of Utah? It's actually, we're actually seeing a fairly good increase over the last couple of years, more so than years previous. So again, when we look at the last handful of years of interest rates in the threes, likelihood of us seeing that again, and giving people perspective on that can be really helpful. So sitting down with your clients again with one of these slides, helping them understand that we were in a really interesting time in the economy and with the pandemic, et cetera, that artificially deflated interest rates, and the likelihood of us seeing that or experiencing that again is that was an abnormal time. All right.
In so many ways.
Yes. All right. So 30-year fixed rates, you have this one in your slide deck. And right now, when we look at the weekly rate and how it's changing, and hearing the messaging from the Federal Reserve, who doesn't directly impact rates necessarily specifically, but does, there's no indication that we're going to see rates come down anytime soon. fact, the Fed is hinting that they're likely to raise rates again at their next meeting. So this is a really important slide for us to understand. So mortgage credit availability index by year. The yellow line is assuming the 100 benchmark, which is that on average, the consumer can afford or get the financing that they need to get an average home, essentially. And so anytime where we're above 100, it suggests that there's cash is readily available. It's easy to get financing to buy a home. When we drop below 100, it suggests that credit parameters are really constricting, getting tighter, and it's becoming more difficult to get financing. So this is really an indication of higher interest rates in part relative to home values, but it's also banks being more conservative on who they're going to lend money to. And both of those things create a challenge for us because it makes it more difficult for our clients to get homes. Now, it also helps us in some ways because it reduces what? Reduces demand. And if we can reduce demand a little bit, it gives us the opportunity to slow down home prices growing. So again, if you look at this on a monthly basis, credit availability is getting more difficult right now than available. Yes, sir.
Just I'm curious, man, do we know what the index was for the Great Recession? Doesn't show up slide. Curious.
Yes, it was like, well, I don't remember what it was, but it was way up here. It was money was there, like you could fog a mirror and they would give you stuff.
Yeah.
Yeah, so you make it a really important point is, for those people that are saying, hey, we don't want to, get in a position that we saw back in 2008, 2009, what's different today? How can I feel comfortable that today's different than then? This is one of the things that we can say is, look, the banks and the regulations that have been put in place have created a scenario where they've tightened up their willingness to give loans much more quickly, such that we are in a much better position to do that. The other thing that you're going to see here in a minute is we're in a very different equity position as far as people having value in their homes relative to when we were in 2008, 2009. This is basically a reflection of refinancing that's occurring. So you can see the huge amount of refinancing that occurred back when rates were super low. Now, this is important because when we understand how everybody in the country essentially refinanced, the vast majority, like something like 80-something+% of loans are well below 4%. When we understand that, we understand why there's such gridlock in people's willingness to move and trade that loan for something better. So you look at the last handful of years of refinancing, it hasn't been great. So for those of us that are, partners in the title company and the mortgage company, right now is a really tough time to be a mortgage company holder because you don't get any of the refinancing. At some point, refinancing will come back, and all of a sudden, that's when mortgage companies make really good money. But it helps us understand how unlikely people are, or how much, what position they have to be in to force themselves to go, I'm going to give up this 3% loan and trade it for nearly 7%. Okay, so foreclosure filings, there's a lot of conversation about, are foreclosures on the increase, and, do we need to start preparing ourselves like we did in 2009 and 2010 to handle bank-owned properties, et cetera? Probably not, right? There's nothing to suggest that we're seeing any kind of dramatic increase in foreclosures. We saw a little pickup in 2022, but still over historical time, very, very low. This is the affordability index. Again, nothing new there. Get that one. Okay, Utah's housing affordability. So I wanted to back up just here. Here's the United States. Remember, the 100 is kind of that benchmark that we look at. And look at Utah. Okay, so what do those two slides mean when we look at them together?
It means it's
Over
more
down.
expensive for people to buy in Utah than in the US general.
Yeah, Utah is dramatically more expensive as it relates to affordability than the United States in aggregate. Yeah. So, we've got some real challenges, especially when we think about the lack of, and there's almost no path right now where we see enough inventory coming on to solve that problem. So this is the challenge that we're really gonna have to identify solutions for. Whether that is regulatory issues that allow builders to build more aggressively. Certainly as agents, finding different ways for alternative financing and different ways for people to get into the homes. Okay. This has inched up just a little bit when we start to look at the last several months. What is causing it to inch up?
What's that?
They're making.
Utah home prices have come
Yeah,
down
there's
a
other
little
stuff,
bit
so.
relative to the country. And Utah's income is getting better. Yeah, so we're seeing a little bit of retreat from that. All right, let's look at investments really quickly. So at yearly average rental rates, you can see what they've done, which is really significant. In many cases, a great argument for trying to buy a home versus paying.
Is that a one bedroom?
I think that's just in aggregate, the average rental rates. Still low.
Maybe a 1.5 bedroom.
But I think it's over all of Utah.
Yeah, I think she takes
Yeah,
it.
that's all. It's all of Utah.
It charges way too much, I can see.
Getting it.
You tied some.
I'm getting it.
Yearly average rate, you can see where they came down, but still, we're still seeing significant increases year over year. So cost burden for Utah's 6 largest counties. So this is kind of an interesting, this is, the blue is the share of housing units that are rented or occupied. So all the units out in the marketplace, how many of them are rent or occupied? And then the salmon color here is renters that are cost burdened, meaning that of the renters, how many are spending more than 30% of their income on rent? Which is that. All of the. All of the other. But this is a shockingly high number, right? That almost half of renters are at extremes as far as
That's so sad.
what they're.
Yeah, but this is from 2 years ago, is that correct? Is there one?
Yeah, this is from 2021, you're right. We don't have the current one, but it's gonna probably be very similar or.
Last slide's from the veterans.
Yeah, so based on this, it's probably. Yeah.
I think having rentals, a lot of renters come in, they're not educated on what they can afford. And so have that champagne taste or beer budget and if people let them in.
It's such a great point, right? Because at least when someone's buying a house, there's a really powerful mechanism to ensure that they can qualify for that monthly payment. Someone's evaluating whether they have the ability to pay that monthly payment every month. In many cases, when we rent properties, there's no filter to say whether people have the ability to make those payments every month. And so, yeah, and it gets them in a vicious cycle when they are paying that much money towards their housing. They don't have the ability to save money towards, ultimately building wealth, making that financial.
When you buying a house too, the lender sees their whole picture, right? Where when you're looking at their income, you're seeing a snapshot of what their income is. So if you're requiring 2.5 times or 3 times the rental amount or whatever, you see that piece of it, but you don't know what else is going on. I mean, you can pull credit and all that, but I think that's critical. And I think especially as rents have gone up so drastically, we're seeing more and more of that. I know you see it, we're seeing more and more people that are just struggling every month.
Well, then when gas and groceries.
And the
also go
gas
up
and groceries and
easily,
everything out there this same time.
More of a rental price now than our housing prices have been debated, but now we're still in rental.
And it's such a valid point too, because if I buy a house today, I have, my payment is fixed. I know what it's gonna look like next year. I know what it's gonna look like in 5 years versus every single time I'm looking at my rental agreements, the rent is not going down. It's going up. And anybody who hasn't evaluated rental, their rents recently should, because the rents have gone up, right? And you wouldn't be smart as an investor if you weren't matching the rental market. And for the people who are continuously renting, it's unfortunate that they're gonna just continue paying more and more and more, most likely, because they're in a situation where it's the hamster wheel. They can't, if they don't get into a situation where they can buy something now, even if it's more in the beer category versus the champagne lifestyle they're used to. It's at least sustains
And
it,
they can't even save for down payment.
right?
Do you have a slide on where you think rents are gonna go?
Well, I think you can just from this, based on the shortages that we're seeing in all of these different categories, we don't anticipate rents coming down and just continually going up, unless something dramatically happens.
Because it's hard when an investor comes and says, hey, I wanna buy a rental property. Mortgage payments more than what they get a rent.
Yeah.
My feeling is that rent eventually is gonna have to surpass that cost.
Yeah.
And I just wonder, like, how long, when I'm talking to an investor, you say, hey, I wanna buy a rental property. Okay, you're gonna be negative for 2 years, but year 3, you'll start making some cash flow. Does that make sense?
Yeah, totally. Like, so the benefit of what Rusty's saying, and one of the games that we all play as investors is having a 30-year fixed rate mortgage that stays consistent over time. And that payment is consistent. Yeah, we have the opportunity over time to raise rents over time, right? And of course, the value of property is going up. The challenges in Utah for a number of reasons. Our rents relative to our values are skewed to not the investor's favor. And we don't see that getting solved anytime soon. But rents would have to go up so dramatically to recapture that difference. So far, we've seen enough inventory of rental units that hasn't been sustained.
In that conversation with the investor, I found it helpful to say, I've started saying, worst case scenario, this is what your rental payment is going to be, but if and when rates fall in the next 2 to 5 years, you have the opportunity to really create that parity that you're looking for.
Yeah.
And, I can't tell you when rates, may come down, but we're looking at a worst case scenario right now.
Yeah.
So that I found that to be helpful.
Yeah, the little term that we use jokingly for this is to marry the house and date the rate. Right, so knowing that you have this great benefit of finding a great property, and then when rates go down, you can refinance that property and get a better monthly payment. So, but it's really tough as an investor right now to find properties that cash flow in this environment. All right, so I'll just say this really quickly, and then we'll just have a handful of slides and we'll wrap up here in just a minute. But anything that we can do as an industry to help find solutions for low income housing options is really, really important for us. And they build, our buyers of the future in so many ways. United States rent growth, you can see the rent growth over the last handful of months is really starting to decline. So in the short term, we're starting to see downward pressure on rent prices. Month over month changes. You can see that, again, the market's starting to swing back up a little bit more favorably, despite, so many people predicting that we're likely facing a recession. More and more, the conversation now is that the recession concerns are getting diluted, and people feel like there's a chance that we might avoid a recession altogether, or it will be a really kind of soft landing or gentle recession. We'll help. Rental vacancy rates still super low. All right, US economy, let's talk about that just for a minute, because I think it's important and understanding, why the country and the Fed specifically raised rates aggressively. I was just visiting my wife's mom, who's this funny little old lady that sits in the same chair all day long. And it's amazingly judgmental of everything. It's incredible. Anyways, she.
It's your wife, not yours.
Those people raising interest rates. Okay, anyways, very now the people raising interest rates, why would they do that to us? To us, it doesn't affect you at all. Anyways. He's very mad about the interest rates. Anyways, so why would the Fed, create this challenge for us? And, I heard an economist say this, that really struck home. Inflation is, one of the number one challenges to our democracy. So if it's one of the greatest threats to our democracy. And when we talk about, those who aren't able to find the means to buy a house or challenged to have rent, inflation just creates that gap further and further. All the people that own properties, the inflation has been okay. Like when I think about the values of the homes that I own, I'm pretty thrilled with that because the debt that I owe on it has not gone up. In fact, it's continued to go down as my tenants pay my rents. But the value of my property has effectively doubled over the last 10 years here in the United States, or in the United States here in Utah. And so, the divide between those who have and haven't just continues to get greater when we have these moments of inflation. And so really getting inflation under control is important for a number of reasons. The risk of getting inflation too high, of course, is that it suffocates the economy and we don't see growth and we have people that lose jobs, et cetera, et cetera. And so that's the needle they're trying to thread. They're trying to slow the economy down so that we don't have gas and bread and all these things cost more and homes costing more so that people can afford to live. And at the same time, they're trying to not slow it down so much that people lose their jobs, et cetera, et cetera. And whether they, did it intentionally or unintentionally, magically, they seem to be doing it perfect. Despite the fact that many of us are frustrated with interest rates being higher, if you look at this data, the economy is still plugging along very robustly. In fact, when we look at gross domestic product year over year, right, 2.1%, we're actually going to look like we're going to outperform that in 2023, being closer to 2.43%. And at the same time, we have the lowest unemployment that we've seen in 40 something years. Like, so there's a lot of really, really good things about this economy. The part of the economy that's getting impacted the most is which part? Housing, right? So congratulations to you all. We're the group that's taking the biggest brunt of the impact. But everyone else is doing quite well. And in reality, when we look at home values, they're staying pretty good. Now, one of my biggest frustrations is when homeowners are like, yeah, it's not too bad. You're like, okay, that's great. Your home value is only down 4%, but the number of transactions are down 45%. So who's getting impacted the very most? Real estate agents and lenders, title companies, right? That's the group that's getting impacted by far the most. All right, unemployment, historic lows, incredibly low. Unemployment monthly, again, still super strong. Hourly earnings, again, this is wages actually increasing still. So, really favorable. Inflation, which is fantastic, is actually coming down just about as fast as it went up. So at one point we got to 9% on CPI, which is kind of a core index that they watch. Now the one or the consumer price index that they watch, the core one takes out energy and food, and that's the one that they're still a little bit concerned about. So we're still at 4.8% for core inflation, but the CPI is down to 3%. Who remembers what the target is? It's 2%. The target's 2%. I heard someone suggest the other day, well, they should just change the goal to 3.
Their goals anyway, just reduce it.
Everything suggests that the inflation is going to continue to come down over the next several months. But because core inflation is still, being a little bit stubborn, that it's likely that and especially because the economy is still staying strong, they're gonna be incentivized to continue to raise rates incrementally. So, great news for the economy, not the best news for us as real estate agents. However, when we understand that, we can start to have conversations with our clients like, this isn't going away anytime soon. There's no incentive for them to lower the interest rates. And in fact, 7% interest rates, historically are really, really good. I remember when Heidi I got our first loan for our house, and it was like at 6.5%, and we thought we were still in money. Like, it was amazing. It was incredible. All right, so you can see that we've included this slide that you've had in the past. This just shows you inflation relative to houses, wages, etc. But the long and short of this is you're really good to own real estate. Where is inflation showing up? Consumer goods, TVs, computers, etc. actually are going down in price. Housing's going up. And you can see the other things are college tuition. This is a big problem. They've got to figure this out. So just 20 years ago, the average acceptance rate at most public universities was like 90%. Today, it's like 10%. I mean, it's just, there's not enough seats for housing amount of time, right?
You have about 10 minutes or so to wrap up, so we can give our.
Here's the funny thing is I don't see any of the stickers anymore where Biden's pointing to the gas station. Well, Biden did that. You can't have it both ways. All right, so fuel and oil down 36%, gas down 26%, natural gas down, all energy down 16%. Rent's gone up, home ownership has gone up, food up a little bit. What's up dramatically? Interest rates, median home payment. Okay. Consumer debt. This is interesting. So we're seeing consumer debt increase again. What happened here? Right? And people were all stuck at home, and then people got sick of being stuck at home, and they had stimulus money, and they had the internet.
And they
Okay, sorry about
bought a lot of stuff on Amazon.
which I'm doing a lot of trips to the DI right now, a lot of that stuff. Okay, annual personal savings rates. So savings rate jumped dramatically during the pandemic. And good news is it's still increasing, but it's well below what the last 10 years has done. So we need people to feel a little more cautious with their money. Consumer sentiment, this is really important. So understanding this, and there's a builder slide that's very similar to this. So this is 2021 and 2022 here. There was a lot of pessimism about what we thought was going to happen in the economy. That started to switch. People are starting to get more optimistic, which is helpful for us as an industry because people are more realistic. They're having that conversation like, okay, this is the new reality. Things aren't as bad as we thought they were. Let's go ahead and buy that house, right? Let's go ahead and move forward.
It's scary that our savings are so low,
Yeah, unemployment.
right?
You can flip through some of these slides. I mean, Utah's so interesting. We continue to lead the country in so many different aspects. One of the reasons why is because of the net migration inwards, and really good at having babies. Woo! Lots of babies helps our economy, so it's good. And it's actually probably in the United States, the number of families choosing to have fewer kids causes a problem for us to see the economy grow like we did. You look at Japan, the UK, some of these other places where their economies have stagnated. It's because they have very much of an aging population with very few new up and comers. So anyways, keep doing the dirty.
Yeah, okay. Someone else says something.
Keep that beautiful thing. Okay, unemployment, low. Talking about that word. Income growth is good. Construction. So this is interesting. We'll just flip through this really quickly. We're still well off. If you look at the last 10 years, this is the number of homes being built across the United States. This is the average, and we just have this massive shortage of homes that are being built. This is Utah residential housing starts. And you can see building permits relative to units. The number of building permits, we 2022, we don't have 23 numbers yet, but you can see how much the building permits dropped from 21 to 2022. That's a problem. Yeah, that's a problem.
Because we quit building. And
Yeah, and we were just way behind all of this, right? Like, look at this huge shortage that we created. And these builders have gotten concerned and stopped pulling permits when we had this massive shortage already. So again, there's nothing to suggest that all of a sudden we're gonna have a surplus. This is residential starts by month, and you can see the long-term trend is upwards. But again, the last couple of months and years is just builders got really spooked by what was going on and saw the cost and all these things, and they put the brakes on. And we need them to come back up. Construction costs have just gone through the roof. As you guys know, that's part of the problem. Land costs have gone through the roof. Builder confidence index. So how much confidence do the builders have on their ability to buy, build, and make money? And you can see 2022 and 2023 really low. Now, the good news, when we look at it on a monthly basis, which just feels monthly, feels like from month to month, it feels like, a mood swing of some sort. Yeah, right. Anyways, this is the end of 2022. And you can see just how low builder confidence got. This is the beginning of the pandemic. All right, so this is right when they came out and started shutting everything down. So builder confidence just obviously fell through the floor. We hit almost that point again at the end of 2022. People were so convinced that interest rates were going up, et cetera, et cetera. But look how builder confidence is starting to kind of roar back here. So that is really good news for us. And between that and supply chains opening up and some of the costs of construction, et cetera, coming down, right? Hopefully we can start to see this dam break free and get a few more homes being built. Okay. You're welcome. You're welcome. Questions, comments, concerns, fears, aspirations?
Thanks, Matt.
Thank you.
Remember, all of this information's great, but what's even better is what you go and do with it. So if you come here today and you've been to a quarterly market update before and you do the same thing that I know a lot of you do, because I see you on social media and I see the people that are sharing the information and talking about it, and I see the people that aren't. So the thing I'm going to say is, before you leave today, you're going to be here for a minute, you're going to do some lunch, you're going to mingle. Before you leave today, before you close out your day, have action items from this that you're going to take and go share, whether you're having conversations, whether you're putting it on social media, whether those are going to be the focus of your quarterly calls that I know you're all making because you're lead generating. But have action items, you guys, because all the information in the world doesn't do you any good if you just know it. There are a lot of people, and your clients are getting information from someone. The question is, are they getting it from you, or are they getting it from whoever's loudest in whatever channel of media they're watching? Okay, so take some action items, make sure you know how to speak to it. Thanks again, Matt. You're so awesome. And we are ready. So Bailey is here. Hi, Bailey. So Bailey is a friend of mine. She owns the company Closing Time. Oh, I do have one quick thing to say. Sorry, Bailey. Can I have one more second? You stay right here by me. I was just coming over to give you a little hug. Okay, if you want to be involved in the pumpkin patch, make sure you talk to Stephanie Phipps over here. She is our chair of it. It is coming up fast and furiously. We have a date. We've got it booked. If you want to be part of it, make sure you talk to her. We need sponsors, so make sure you know who you want to have conversations with, but talk to Steph first, because some people have already said, nope, this is ours limited, no other company can come in. So talk to Stephanie if you want to be in the pumpkin patch. Now Bailey is here for closing time. One of my great friends owns this company, and I'm excited for her to tell you a little bit more about it.
Thank you so much.
You're welcome.
Hi, everyone. My name is Bailey and I'm with Closing Time Gifts. We are a custom closing gift company. We also do referral gifts and pop buys. We do super custom things like for your clients, we can do like, I got a Star Wars request. One time I got like a hippie boho vibe request. So we can do just about anything. We carry products for everyone in the family, including the cats and the dogs and the babies. So we have barbecue stuff, home decor, tons and tons of snacks. We try to support local as much as we can. So we carry a lot of locally made products in our gift baskets. They start at about $30. Baskets specifically start at about $30 and go up as you desire. We can do alcohol per your request as long as you promise that your clients are of the age. And we also do pop buys. I get a lot of orders for pop buys. So just a little, hey, I'm thinking of you gift, which is a good way to keep you at the top of mind with your clients. And then referral gifts. Thank you for referring my business and helping me grow. We do offer local pickup. We're on 25th Street, and then I can do delivery in Box Elder, Cache, Weaver, and Davis County. And then we also ship out of state. We carry Utah products, like Utah themed products, cutting boards, cups, and a couple of other things. And then we can also get other states if your clients are relocating or moving in from another state. So we have just about any option that you can want. And if we don't have it, then I can find it. And yeah, we have a lot of gifts that are just like, you know, your average run of the mill gifts that are super nice, or we can get really custom with it. So whatever you prefer. I do have some example gifts out there. There's some of our smaller gifts, just for transportation sake, but I did print out some flyers, and it has examples of some closing gifts we do, and also our pop buys. And then there is colored pencil, little crayon packs, if you want to take some home to your kids, as well as pens and chapsticks. And then my phone number is on there. So if you'd like to place an order, feel free to give me a call or a text. Our website is not super user friendly. So if you want to place an order, I would prefer if you text or give me a call. I'm also an agent, so I understand the hustle and bustle, and also the hurry up and wait, and how fast things can change. So I'm here at your disposal. I can, something super specific, I prefer about 48 hours notice. But if you're just looking for a run of the mill, I can typically get something to you within a couple of hours. Yeah, so if you'd like to order anything, feel free to reach out.
Can I give a little personal testimonial? So I had a friend that was visiting from Utah, and I called and I said, hey, I want to send them something to like make sure that Utah made an impression on them. And so they put together the cutest basket, sent me a picture of it. It's boxed nice. You guys, that made the biggest impression. So think those things through too. We talk a lot about, you should be getting referrals from other KW agents. What would it look like if you called and said, Bailey, I have 15 people in my referral database that I want to send something to from Utah. Here's my budget. And she can make it work. I did it at Christmas too. I said, here's my budget. Here's how many I need. What can you come up with? And so anyway, I personally use Closing Time. I think they're great. So make sure you chat with Bailey. Thank you guys for coming. I would love for you guys to start sharing your action items that you're going to take away in our Facebook page today, so that we all can hold each other accountable. Thanks, guys. Did everybody sign up to watch live? If you didn't, Jane didn't. Okay, if you didn't, make sure you get this. Thank you.